Lloyds already has a strong position in the global reinsurance market, but faces an increasingly difficult operating environment. I'm Yvette Esson for AM Best TV, and I'm joined by Jessica Botelho-Young, Senior Financial Analyst for AM Best, to talk about the Lloyds market. First of all, can you explain to me what was our reason to affirm our rating for the Lloyds market in July?
So Lloyds' ratings reflect a very strong balance sheet strength, a strong operating performance over the cycle, a favorable business profile, and appropriate enterprise risk management. If we look a little bit more closely at the balance sheet strength assessment, Lloyds' risk-adjusted capitalization, as measured by the best capital adequacy ratio, or the BCAR model, is at the strongest level. Capital adequacy is supported by a robust capital setting process for the members, and also benefits from the strength and accessibility of the central fund. Our assessment does also consider the fungibility constraints of capital at the member level, as it's not available across all syndicates. The Lloyds market is also subject to a high level of catastrophe risk. In a conventional insurer, this could lead to some volatility in risk-adjusted capitalization. However, through the unique sort of capital setting requirements of members who would need to replenish their funds at Lloyds after an operating loss, this really is managed through that unique process.
Now, we've just published a report looking specifically at the reinsurance market in Lloyds, and we do say that it has a strong position. Can you highlight some numbers to tell me about that position of Lloyds in the reinsurance market?
Sure. So these are all based off of year-end 2018 results. Right now it looks like Lloyds has maintained their position as the 6th largest risk carrier based on reinsurance gross premiums written. And when you look exclusively at non-life reinsurance, that position improves to the 4th largest. At year-end 2018, 31% of all the gross written premium written by Lloyds relates specifically to reinsurance. And of reinsurance, they look mainly at property, casualty, and specialty reinsurance.
One trend that we have noted is that Lloyd's expense ratio is high compared to its peers. Why is that?
Yeah, at year-end 2018, the expense ratio was about 40% and really has been stable at that level for the past several years. Part of it can be explained that over the past several years, there's been a change in the business mix, with more business, about 1/3 in 2018, is written through cover holders, so the acquisition costs are more expensive to write that type of business. So it's important to remember that Lloyd's is a market. So a conventional insurer is able to more easily implement change, whether that's improving their technology and really pushing cost containment policies more easily, because it's one owner, one business, whereas the Lloyd's market is a market of competing businesses. So it's just the way the market operates makes it quite difficult to lower that expense ratio.
You mentioned change there. What is Lloyd's doing to try and change things? What is it trying to do in the future to reduce expenses and improve operating performance?
So it's important to say that the last 2 years, the operating performance of Lloyd's has been impacted by above average catastrophe losses. Now, we feel that the catastrophe losses that Lloyd's did incur were completely in line with our expectations, and we saw it across others in the market. However, there has been a steady deterioration in the attritional losses, which hasn't been in line with our expectations. And evidently it hasn't been in line with Lloyd's expectations either. So about 2 years ago, this became an area of focus for Lloyd's. And John Hancock and his performance management team have taken actions with the goal of improving the overall operating performance of the market. Now, some actions include really the scrutinization of business plans. So all syndicates were required to look at the worst performing classes of business, and as part of the business planning process, provide credible plans of how they were going to return these classes back to profitability. And I think they've been very public and open in saying that where plans were not credible or where they could not agree with the syndicate that this plan was going to be feasible, they would take actions including closing syndicates. And we have seen that. So we've seen the closure of several syndicates, as well as certain syndicates exiting complete lines of business. So really like some bite to the bark in terms of actions that the corporation has been doing.
Are there any other actions that Lloyds is taking that might be worth mentioning that might also help improve the operating performance?
Earlier this year, Lloyds released the Future at Lloyds prospectus. And it's quite an ambitious, robust plan of what changes they'd like to see at Lloyds. The one that I'll kind of focus on relates to improved efficiency, particularly in the claims management process, as well as the improving the accessibility of the market whilst trimming the cost of doing business at Lloyds. So I guess our feeling is that if they're able to effectively do this, it could lead to some meaningful cost reduction, which would support an improved overall operating performance. But like any ambitious plan, a high degree of execution risk exists.
A copy of AM Best report looking at trends within the Lloyds reinsurance market can be found on ambest.com. For AM Best TV, I'm Yvette Essen.